At exactly 9:43 a.m., Michael's phone vibrated. He looked at the screen and saw his investment account plummeting. His portfolio was worth almost $800,000, but now the number was dropping by thousands of dollars every 60 seconds. We can see the speed of the collapse here. $795,000, $781,000, $754,000. At this rate, years of work were vanishing. Michael had two choices: stay calm or sell. At 9:47 a.m., he pressed the button. Sell all. The numbers stopped moving. For a few moments, he felt a massive rush of relief. The red numbers were gone, replaced by a stable cash balance. He put his phone down, convinced he had just saved his family's future. He had successfully removed the immediate physical pain of the crash. But in the world of compounding, prioritizing how you feel in the next 10 minutes means sacrificing how you live for the next 10 years. Michael didn't save his future. He had actually just made the single most expensive mistake of his life.
We're taught that investing is a game of math, charts, and spreadsheets. In reality, it's a biological survival game. Having the right data is useless if you can't manage your own pulse. Building wealth is less about predicting where the market is going and more about knowing exactly where your own logic will break. Michael's relationship with money started with caution. Growing up, he watched his father sit at the kitchen table every Sunday with envelopes for electricity, rent, and school. His father always said that if you don't control your money, it will eventually control you. When Michael started investing at 24, he was disciplined. He began with just $200 a month, buying into the market slowly. He didn't want to get rich. He wanted to be free. 5 years in, his portfolio reached $35,000. Then, the market entered a period of extreme growth. His balance nearly doubled in months, and suddenly, Michael was the person his friends came to for financial advice. This is where his perspective shifted. These two lines show the market average compared to Michael's portfolio. They move in perfect sync. Michael didn't see it was the market doing the heavy lifting. He began to believe he had a personal gift for picking winners. That confidence changed his behavior. He met a professional trader named David, who laughed at his slow strategy. Michael started buying individual stocks, then complex options, and finally trading on margin, borrowing money from his broker to buy even more. A rising market acts as a mask. It hides the danger of debt and makes a reckless strategy look like a stroke of genius, right up until the moment the environment changes. By the time the news cycle turned negative and volatility returned, Michael was too deep to be objective. Because he had been winning for so long, he viewed every dip as a chance to double down. He used even more leverage, borrowing against his gains to buy the bottom. This pushed his total position to that $800,000 peak, but much of that wasn't his money, it was debt. On Monday morning, that structure collapsed.
As prices fell, the money he had borrowed forced him to pay it back immediately. Between 9:35 and 9:43, he watched a decade of savings evaporate in a few phone vibrations. In that moment, your brain stops thinking about the next 10 years. It only cares about stopping the pain of the next 10 seconds. The biological impulse to survive makes it impossible to follow a long-term plan. When you build a portfolio on debt and overconfidence, your strategy doesn't just bend under pressure, it shatters when you face a real loss. The irony was almost immediate. This V-shaped chart shows the market action that day. Just 2 hours after Michael sold his entire life savings, the market bottomed and began a massive recovery. By the end of the day, the crash was over. Michael watched from the sidelines. As the market line climbed back up, his account stayed perfectly flat in cash. He told himself he was just waiting for a sign that it was safe to go back in. But he was actually tethered to the price where he sold. He couldn't bring himself to buy back in at a higher price than where he walked away. He was waiting for the market to return to the bottom just so he could feel even, but the market kept moving without him. If you can't admit you were wrong, you become paralyzed. Michael turned a temporary dip into a permanent loss by refusing to accept the price the market was offering. Weeks later, Michael sat in his father's backyard and confessed everything: the leverage, the peak, the panic, and the recovery he had watched from the sidelines. Michael told his father he had lost $100,000. He was looking at his physical bank statement, thinking his failure was limited to the money that had already disappeared. His father pointed to a much larger problem: opportunity cost. The small red bar is the cash he lost on Monday. The towering bar next to it is the decades of compound growth that money would have generated if he had just done nothing. A market crash is a temporary drop in value, but selling out of fear is a permanent destruction of future wealth. The real cost wasn't just what he lost that morning, it was what he permanently gave up for the next 30 years. 10 years later, at age 52, Michael has rebuilt. His portfolio is healthy again, but the way he manages it has changed completely. He no longer uses leverage. He doesn't check his phone. He uses a boring, automated system that broadly diversifies his money and keeps enough cash on hand so he never feels the biological need to panic. He finally accepted the market doesn't know you exist. You can't control the price, but you can control your own behavior. He stopped trying to be a genius and started focusing on being disciplined. He replaced excitement with a commitment to consistency. True wealth isn't built by making the perfect trade at the perfect time.
It's built by making reasonable decisions and having the emotional endurance to survive your own feelings when the rest of the world is panicking.